Most people in the UK dream about a £1 million fire number, but can't even scrape together the first 100K. So in this video, I'm going to show you exactly why that first £100,000 in Bitcoin changes everything, and why, if you try to act like Michael Saylor before you get there, the market will happily keep you broke forever. Bitcoin has already crashed from around $126,000 to the low 80s this cycle, nuked almost $2 billion in leveraged positions in a single day, and wiped out roughly 390,000 traders. If you don't understand what that means for your first pound 100K, you are not investing. You are volunteering to be liquidity. In November 2025, the crypto market reminded everyone what happens when you try to play Michael Saylor with corner shop money. For months, Bitcoin had marched higher, pushing through six figures in dollars and flirting with levels around 120,000. Then, almost overnight, it fell off a cliff. In a few brutal weeks, the price slid from that 120,000 region down towards roughly $80,000, and about $1 trillion in crypto market value simply vanished. On one of those days, around the 20th of November, the numbers were obscene. Bitcoin dipped towards $81,000, and nearly $2 billion worth of leveraged positions were liquidated inside 24 hours. Exchanges reported roughly 390,000 traders blown out in a single session. That is not a typo. Picture Wembley Stadium full 4 times over, and every single person in those seats getting the same message: your position has been liquidated. The fear gauges told the same story. The crypto fear and greed index dropped to 11 points, the extreme fear zone we last saw when FTX collapsed back in November 2022. Meanwhile, the liquidation engines on the exchanges did exactly what they were built to do: cut any position without enough margin, no mercy, no drama, no motivational speech. Here is the part nobody likes to admit. If you have not yet built a solid 100 grand invested in a half-decent portfolio, the market does not see you as an investor. It sees you as fuel. With 5 grand, 10 grand, maybe 20 grand in crypto, every 10% drop feels like the end of the world. Because that money is not robust capital, it is recent wages. You feel the pain like an adult, but your net worth is still crawling. Now set that next to the game Michael Saylor is playing. By mid-2025, Strategy, the old MicroStrategy, reported roughly 597,000 Bitcoin on its balance sheet, about 2.7% of the entire supply. Analysts showed that the company's shares behaved like a leveraged Bitcoin proxy, with a kind of 3-to-1 beta. A 10% move in Bitcoin could mean 30% in the share price, up or down. In the bull phase, that helped the stock do a 10-bagger from the start of the strategy. In the October and November crash, the same structure helped sink leveraged ETFs tied to strategy by more than 80%. The difference is simple and brutal. When Bitcoin dumps again, Saylor still has hundreds of thousands of coins, credit lines, the ability to issue more shares, and years of runway to be wrong. You have a UK salary, council tax, rent that goes up every year, and maybe a few thousand in crypto sitting on some exchange. When he gets it wrong, the headlines talk about a drawdown. When you get it wrong with leverage, the email says, account liquidated. That is why, When I talk about the first 100K in Bitcoin, I am not talking about getting rich. I am talking about stopping being cannon fodder. Until you cross that invisible line of 100,000 pounds invested, every mistake sets you back years. After it, for the first time, a simple 10% return actually means something. 10,000 pounds in a year, roughly a decent part-time job, generated by the market while you sleep, without pretending you are Michael Saylor with supermarket money. Most people in the UK who talk about financial freedom actually know how to do the maths. They know the FIRE rule. Take the yearly spending you want, multiply it by 25, and that is your number. If you want 40,000 a year without a boss, you are aiming at roughly £1 million. If you are prepared to live on 20 to 25,000, you are still looking at something between $500,000 and $750 grand. Scroll through any FIRE UK forum and you will see it. People in their 30s and 40s saying, my FIRE number is 500K, mine is $1 million, I need 1.2 to feel properly sorted. The dream is crystal clear. The problem is the starting point. A lot of those same people are still stuck with total investments under 20 or 30,000, sometimes under 10. They are talking about a 7-figure destination while still fighting to save 200 quid a month. I have been in that gap. You open a FIRE calculator, type in, I want 40K a year, and the tool calmly tells you you need £1 million, and a part of your brain just laughs. 1 million might as well be the GDP of a small country compared with the balance on your app. That is the moment most people quietly decide, saving and investing is too slow. I need something with more juice. And in 2025, more juice usually meant Bitcoin with leverage. You look at what Michael Saylor did, and the story sells itself. Since he kicked off the Bitcoin strategy back in 2020, Strategy's share price has, in the good stretches, outperformed Bitcoin itself, at one point doing a 10x while Bitcoin only did about 5x from the pandemic lows. Analyst notes in mid-2025 were still calling MSTR a high-alpha leveraged Bitcoin play, talking about 3-to-1 beta and asymmetric upside if Bitcoin ever reached $140,000. When you are sitting there with 15 grand in your brokerage account, it is very easy to think, if I just behave a bit more like Saylor, maybe I can shortcut a decade. What you forget is what sits behind his bet. Strategy is running close to 597,000 coins on a corporate balance sheet. It has issued bonds, convertible notes, and multiple series of preferred shares, and it has used at-the-market equity programs to raise tens of billions of dollars in dry powder. When Bitcoin pulls back, the company can roll its debt, sell a slice of equity, tighten its belt for a couple of years. If it really had to, it could even sell a chunk of its Bitcoin and still sit on a mountain of coins. That is what real leverage looks like. Risky, yes, but backed by assets, cash flow, and time. Your version of leverage is very different. It is a CFD or a perp on your phone, 10x dialed in because 5x feels weak, backed not by a billion-pound bond program, but by your next pay packet. When Bitcoin drops 15% in a bad week, Saylor has an ugly quarter. You have a margin call. When Strategy's stock falls 30 or 40%, institutional holders grumble, write reports, maybe trim their positions. When your account falls 40% on leverage, You are not trimming. You are gone. That is why the first 100K matters so much. With less than that, you are trying to copy a billionaire's playbook with what, in his world, would barely cover the catering bill for one investor day. You are playing a long-term game with short-term money. Every time the market shakes, you are forced to react because you have no cushion. You cannot sit through a 30% drawdown because a move like that on thin, leveraged capital is not volatility, it is game over. So before we even start a serious conversation about turning the first 100K into $500,000 or a full million, we have to be honest about phase one. Phase one is not being clever. Phase one is not finding the next MicroStrategy. Phase one is grinding your way out of the zone where every mistake is fatal. That means building capital slowly, boringly, while the rest of the crowd uses Saylor's name as an excuse to do exactly what the liquidation engine loves most. Turning wages into cheap liquidity for people who already have real capital. The first 100K is important for one simple reason. It is the point where the numbers finally stop insulting you. Before that, compounding feels like a bad joke. You save $5,000, the market does 10%, and you have made 500 pounds. 500 is an emergency plumber, a knackered clutch, a couple of dentist visits. Nothing about it feels like freedom. That is why most people give up during the small numbers phase. They put away a few hundred every month for a year, watch the portfolio crawl from 5 to maybe 7 or 8 grand, and think, what is the point? In 2025, it was even worse, because just as people were starting to see those small gains, November showed up and wiped 10 to 20% off Bitcoin in a handful of sessions. For someone with 10K in the market, that looks like months of effort gone in a week. For someone with 100K, it is annoying but survivable. I remember the first time my annual gains matched what I could save from my pay. It did not happen at 10K or 20K. It happened closer to that 100K line, when a 10 or 15% year suddenly meant 10 or 15,000 pounds of growth. That is when your psychology changes. You stop seeing saving as deprivation and start seeing it as feeding a machine that can actually move the needle. The market, of course, does everything it can to stop you reaching that point. In October and November of 2025, it threw the full menu at you. A so-called perfect storm of tariffs, risk-off sentiment, thin liquidity, and over $3 billion in hourly liquidations at one point in October, followed by that $2 billion wipeout day in November. Bitcoin dropped below the psychological 100K dollar level, flirted with 85K and even 81K on some venues, and headlines screamed about the worst month since FTX. If you were still in the small numbers phase, it felt like the universe was mocking you. But that is exactly how compounding always looks in the early years. The returns are just big enough to notice and just small enough to feel pointless. You put 25 grand into the market over a couple of years, it earns maybe 2.5 or 3 grand in a good year, and then one bad month takes half of that back. From the outside, it looks like running on a treadmill. From the inside, it is the only way through. The irony is that those boring, frustrating years are the toll you pay to earn the magic later. You cannot skip them. You cannot hack them with one clever trade. You cannot make the numbers double just because you are impatient. Every billionaire who talks about compounding is quietly describing the same unglamorous decade, the decade where they kept putting money in, watched it barely move, and did not quit. So when you see people in 2025 moaning that their Bitcoin stack only earned a couple of thousand before the crash took it back, understand what you are really looking at. You are looking at the entrance exam. The market is asking a simple question. Can you survive the years where the numbers do not impress anyone, including you? If the answer is no, if you need fireworks straight away, you will never see what compounding actually does once you have 100K or 200 or 500 working for you. The quickest way to stay poor is to let your lifestyle sprint every time your income jogs. That is the trap most people in the UK fall into long before they ever see their first 100K. They get a pay rise, and the first instinct is not brilliant, more capital. It is brilliant. I can finally upgrade the car, move to a nicer flat, book that holiday I could not justify last year. On paper, they are earning more. In real life, they are exactly where they started, just with slightly shinier problems. I have watched people on six-figure salaries in London live one payslip away from panic. Lawyers, consultants, mid-level bankers pulling in 100 grand a year and somehow still skint at the end of the month. The BMW is leased, the big house is mortgaged to the hilt, the school fees are hanging over them like a cloud. From the outside, they look sorted. From the inside, they are as fragile as a 0 hours contract worker, just with nicer clothes. This is where the first 100K in Bitcoin, or any serious investing, collides with ego. To build that base, você tem de aceitar parecer below your pay grade durante bom tempo. It means driving the old banger a few years longer, staying in the slightly cramped flat, saying no to the lad's trip to Ibiza, even though technically you could stick it on a card. It means letting your mates call you tight while you quietly shovel surplus cash into assets that do not post on Instagram. Historically, the people who actually crossed that line did exactly that. If you look at the old stories around Charlie Munger's first 100K is a bitch. Quote, the pattern is always the same. Years of grinding, low lifestyle, high savings rate, boring compounding. In the crypto context of 2025, that might mean you do not ape into every new token or leverage trade. You focus on stacking sats, keeping your overall savings rate high, and refusing to let every pay rise turn into a fancier car or a bigger telly. The market will constantly tempt you to do the opposite. In the first half of 2025, when Bitcoin was pushing towards $120,000, there were months where it felt like everyone on YouTube was telling you to celebrate, borrow, upgrade, spend, because number go up. Then November hit, Bitcoin crashed towards 80, and suddenly the same crowd started talking about staying strong while quietly hedging or cashing out. If your lifestyle had already expanded to match the peak, that drawdown hurt twice, in the portfolio and in the monthly budget. The truth is ugly but simple. Until you break the habit of turning every extra pound of income into lifestyle, you will never build the capital that makes compounding interesting. You can watch every Saylor interview, read every Bitcoin book, binge every FIRE forum. If the moment your salary bumps from 40 to 50 grand, you immediately bump your spending from 35 to 45, you have told the universe, I choose status over freedom. And the universe, very politely, will give you exactly that. Nice photos, no assets. Debt is just compounding working against you, wearing a different shirt. People love to talk about compound interest when it is their Bitcoin stack or their index fund. They forget it is doing exactly the same thing on the other side of the balance sheet, in their credit cards, car finance, and personal loans. 10% yearly growth on a portfolio sounds exciting. 20% annual interest on a card balance is financial self-harm. In 2025, I saw people bragging that they had made 10% on crypto while quietly carrying credit card debt at nearly 20% APR. That is not investing. That is self-sabotage. Every pound of interest you pay to the bank is a pound that will never join your first 100K army. It is capital that could have been compounding for you, now marching in the opposite direction. Crashes make this worse. In October, there was that $19 billion liquidation event driven by leverage and macro headlines. In November, another $2 billion in leverage positions were wiped as Bitcoin slid below 90, then 85, then flirted with $81,000. A lot of people went into those months already loaded with debt, thinking they could pay it off quicker by being aggressive in the market. When the trades blew up, they did not just lose capital. They kept the debt. That is the cruel thing about borrowing to chase a big score. Debt does not care about your conviction. It does not care that you believe Bitcoin will be higher in 2027 or that Saylor is still buying. Interest keeps ticking every day, whether your latest gamble worked or not. In 1973, in 2000, in 2008, people learned that the hard way, buying shares on margin. In 2025, a new generation learned it in perpetual futures. If you are serious about getting to that first 100K, the order of operations is boring and non-negotiable. Kill expensive debt first. Then build the savings habit. Then invest. Taking out 5-year car finance at 10% while you try to squeeze 10% a year out of Bitcoin is like trying to bail out a boat with a hole in the bottom. The harder you work, the more water comes in. Leverage, when you are already in debt, is just strapping explosives to that hull. It might get you there faster in a fairy tale scenario where every trade goes your way. In the real world, where November 2025 style crashes happen, it just means that when the wave hits, you do not just fall back to zero, you go negative. And climbing from minus 20 grand to plus 100K is not a mindset hack. It is a decade of pain you could have avoided by not handing compounding to the bank in the first place. Everyone loves the idea of compounding. Almost no one loves the reality of waiting. That is why the first 100K filters so many people out. It is not because the maths is complicated. It is because the process is mind-numbingly dull. Think about the timeline. For most people in the UK, even saving $10,000 a year is a push. At that pace, without any help from the market, it is 10 years just to hit 100,000. If the market gives you 5 or 10% along the way, you can shave a couple of years off. Still, you are talking about most of your 20s and 30s watching a graph crawl. During that same decade, life does its best to knock you off course. You get hit with rent rises, kids, breakups, job changes, surprise tax bills. In 2025, you also got hit with a Bitcoin cycle that went from inevitable new highs in October to second worst month of the year in November, with almost 1 trillion wiped off the crypto market. Every one of those hits is an excuse to say, sod this, I am spending the lot, I will think about fire later. The people who actually crossed the 100K line did something very unmodern. They accepted boredom. They did not need every year to be 20% up. They did not yank money out of their portfolio every time the S&P or Bitcoin had a flat quarter. They let small, unimpressive returns stack on top of each other while everyone else chased excitement. In 2025, the temptation to chase excitement was everywhere. New tokens promised next Ethereum upside. Leverage platforms dangled 50x buttons like sweets at the till. Influencers shouted about insane gains from microcaps that had not even survived one full bear market. Meanwhile, the boring move. Buy quality, size sensibly, sit on your hands, quietly did its job for the tiny minority with enough patience not to click everything that flashed. The funny thing is, once you finally drag yourself through that boring decade, the game flips. There comes a year, maybe at 100K, maybe at 200, where your capital earns more than you can reasonably save from your salary. Maybe your portfolio throws off 40 grand in a good year while you only manage to squirrel away 20. That is the point where compounding stops being a theory in a book and starts feeling like a second, invisible job that never sleeps. Most people will never feel that switch, not because they are stupid, but because they cannot stand the stretch where nothing seems to be happening. They pull the plug just before the curve starts to bend. They spend the early compounding years cashing out small wins to enjoy life, then look up at 50 and wonder why they are still one mortgage payment away from panic. The market did not cheat them. They just refused to pay the entry fee, years of small, boring numbers that nobody claps for. There is a moment in wealth building that feels almost supernatural the first time it happens. It is the year your capital quietly earns more than you manage to save from your job. Until that point, every pound in your portfolio came from your sweat. After that point, you realize the roles have flipped. You are no longer carrying your money. Your money is finally carrying you. That moment does not arrive at 5 grand or 10 grand. It usually shows up somewhere after the first 100K, sometimes closer to 200, when a 20% year means 40,000 pounds of growth. In the context of 2025, that is the difference between watching Bitcoin drop from 120,000 to 80 and thinking, my life is over, versus thinking, annoying drawdown, but the engine still works. One reaction belongs to someone whose net worth is their last few wages. The other belongs to someone with real capital. When your capital starts out earning you, your psychology changes. Saving no longer feels like self-denial. It feels like feeding a machine that demonstrably pays you back. You stop obsessing over whether to spend 50 quid here or 100 quid there, and start obsessing over keeping the machine alive, staying out of dumb debt, avoiding panic selling, refusing to nuke the portfolio for a hot tip. The trade-off shifts from car now versus vague future to small treat now versus extra 5 or 10 grand next year. The tragedy is that a lot of people hit this inflection point and then blow it. As soon as the portfolio crosses 6 figures and starts compounding properly, they start to feel clever. They forget that it took a decade of grinding and boredom to climb that hill. They start telling themselves a new story. I am not just disciplined, I am talented. Maybe I am the next Saylor. Maybe I should take more risk now that I have a cushion. That is how 10 years of work disappears in one stupid, over-leveraged trade. The market of 2025 offered infinite ways to self-destruct at exactly that stage. You could borrow against your portfolio to chase the next alt season. You could YOLO into options or 50x perps because I am playing with house money now. You could listen to people telling you that a drawdown like November was the last shakeout before mega bull and double down instead of respecting risk. Each of those choices turns a hard-earned compounding engine back into a ticking bomb. The channel's whole message boils down to this. Do not confuse having capital with having superpowers. The first 100K buys you a seat at the table. It does not make you invincible. If you treat that six-figure base as a license to behave like a hedge fund while still thinking like a retail punter, the market will happily send you back to zero and charge interest for the lesson. The real flex is not turning 100 into 150 with some lucky punt. The real flex is keeping that 100 alive long enough for compounding to do what November crashes can never undo. The market is ruthless, but it is not random. It has a favorite test it runs over and over. What do you do when everything looks cheap and everything feels terrifying at the same time? November 2025 was that test in high definition. Bitcoin had erased the year's gains, dropped below the $100,000 line, and briefly traded in the low 80s. Headlines screamed about contagion, crypto winter, and retail wipeout. In that environment, behavior split sharply. Retail traders who had tried to get rich fast on leverage were being forcibly flushed out. Roughly $2 billion in positions liquidated in a day, almost 400,000 accounts blown up. At the same time, on-chain data and ETF flow reports showed something more boring happening in the background. Larger players were quietly adding. The number of so-called whale wallets, addresses with more than 1,000 Bitcoin, had been creeping up from around 1,350 to over 1,450 since the previous year, with a noticeable bump during the November fear. That is the difference between having capital and chasing it. If your net worth is 10 grand and half of it is on 10x long, a 20% drop is a personal catastrophe. If you are sitting on a few 100K in relatively unlevered assets, a 20% drop is a nasty sales sign. The chart is the same. The event is the same. The outcome is completely different because of what you walked into it with. This is why the first 100K is not just a number, it is a threshold of optionality. Below it, crashes only ever feel like punishment. Above it, they start to feel, at least occasionally, like an opportunity, not because you enjoy losing money, but porque você finalmente tem munição para comprar quando os outros estão a ser forçados a vender. You are no longer the one praying that the liquidation price holds. You are the one deciding, calmly, whether the risk-reward justifies adding. Look at how institutions behaved around that time. U.S. spot Bitcoin ETFs saw roughly $3.79 billion of net outflows in November, as some funds de-risked. Yet by early December, reports were already noting that inflows had started to creep back in as prices stabilized in the 80 to 90,000 range. The so-called smart money was not all-knowing. It was simply liquid, patient, and unlevered enough to step back in after the panic. If your plan is to reach your own fire number, You have to decide which side of that divide you want to be on in the next crash. The side that is forced to sell at any price because the mortgage, the cards, and the leverage leave you no choice. Or the side that can look at a November-style flush, breathe, and say, ugly, but interesting. Getting to the first 100K is how you earn the right to be in that second group. It does not guarantee you will act wisely when the time comes. But without that base, you will not even be invited to the conversation. By now, the pattern should be obvious. The hard part is not understanding what to do. It is doing it for long enough. The rules that get you to the first 100K are embarrassingly simple. Spend less than you earn. Kill expensive debt. Put the surplus into assets that actually have a chance of compounding. Bitcoin, broad market funds, productive businesses, not lottery tickets with a white paper. Repeat for years. People hate that answer because it does not make them feel special. There is no secret Saylor trick hidden in a footnote. There is no magic month where you go from 10K to 100 overnight without taking the kind of risk that also takes you back to zero. In a world where every algorithm is trying to sell you a system, this channel is effectively saying, congratulations, you are stuck with discipline. What November 2025 did was strip the marketing away. All the clever leverage products, all the shiny altcoins, all the next big thing narratives ran headfirst into the oldest law in markets: when the tide goes out, anything fragile breaks. Traders who had convinced themselves they were playing four-dimensional chess discovered they were just pawns on somebody else's board. Meanwhile, the boring crowd, the ones who had spent the last 5 or 10 years quietly building, avoiding stupid debt, refusing to live at the edge, took a hit, swore a bit, and carried on. So if you want a checklist for getting to that first 100K without blowing yourself up, it looks something like this. No high-interest debt, none. If your card is charging you 20%, that balance is your main investment, in the worst way. Savings rate that actually hurts a little. 10% of income is fine for people who want to retire at 65. If you want fire, you are probably looking at 20, 30, sometimes 40% during your prime earning years. Exposure to Bitcoin, size so that a 70% drawdown is painful, not fatal. If a repeat of 2025 would liquidate you or force you to sell at the bottom, you are overextended. Absolutely no pretending you are Michael Saylor until you have at least 6 figures of unlevered capital, and even then, preferably never. None of that will impress anyone at the pub. But that is the point. The game that actually works is the one nobody applauds in real time. Years from now, when someone asks how you managed to get lucky and hit your fire number, you will know the answer was brutally boring. You stopped being cannon fodder, you built the first 100K the hard way, and you refused to let crashes, lifestyle creep, or leverage stupidity knock you back to the starting line. At this point, the conclusion almost writes itself, but it is worth spelling out, because the world will keep trying to sell you shortcuts. The first 100K is not a finish line. It is the starting gun. It is the moment you stop playing defense all the time and finally have a small army of pounds working on your side. You will be tempted to celebrate that milestone in exactly the wrong way. Upgrade the car. Stretch for the bigger house. Take on a bit of smart leverage because I have a cushion now. That is how people crawl up to the edge of freedom, look around, and then happily jump back into the hole they just spent a decade climbing out of. The market does not care how long it took you to get there. It does not care how many evenings you stayed in while your mates went out, how many holidays you skipped, how many gadgets you did not buy. If you start behaving like the rules no longer apply after 6 figures, November-style crashes will take your money as gladly as they took the money of every over-leveraged newcomer in 2025. So here is the unsexy final takeaway. Get to the first 100K by any honest means necessary. Cutting expenses, increasing income, refusing to inflate your lifestyle every time your salary twitches, staying away from toxic debt, using Bitcoin and other assets sensibly instead of as a casino. Once you are there, do not suddenly decide you are special. Double down on the same discipline that got you up the hill in the first place. You do not need to be the smartest person in the room to reach your fire number. You just need to avoid being the person who keeps handing their future to the bank, to the broker, and to every shiny new scheme that promises to skip the boring part. The difference between the people who stay broke and the people who quietly get rich is not genius. It is who is willing to endure years of dull, disciplined progress until compounding finally starts shouting louder than the crashes. Build the first 100K like your life depends on it, because financially it does. And then let time, not leverage, do the heavy lifting.